Thank you everyone for coming on online, giving us your time today. We always appreciate you guys taking your time out of your day. And that's why we always want to have valuable content for you. And this is where we started doing these questions off the top to provide at least some new insight every week. And we get it often. People come to us and our clients that have previously purchased, like, hey, I want to sell an assignment. And if you go back, there's video of years ago, videos of us telling you not to sell an assignment. It's a terrible idea. Now it's even a worse idea to sell on assignment. The math is just does not make any sense at all. And Kyle will show some math after I just discussed the point. So number one reason you shouldn't sell an assignment, taxes. So at the beginning of 2023, well, this was the case before assignments, but basically what it is you aren't eligible for the capital gain exemption when you sell an assignment. So what that means is any profit that you may have when you're trying to sell an assignment, that's going to be taxed at the full 100% rate. So all that income has to go, or all that profit has to go into your income. Now, if you wait 1 year on the sale, and that's the starting of this year, you need to own a property 1 year to be eligible for that 50% capital gain exemption. If you own the property for 1 year, then only 50% of that profit will go into your income. So that's a huge tax savings there. And again, we're going to show you real life examples just after we get through these points. Number two, when you sell an assignment, you're not selling a resale property. So the government says, hey, you know what, I want some additional tax on top of that. So they're going to charge you, in this case, Calgary, they're going to charge you GST on the profit. So you have to pay 5% on top of the profit. The government's going to want that as well. And then number three is when you're doing assignment sales, end users aren't going to buy assignments because end users want to see the property. They want to go in, they want to go see what they're living in. So the only market for assignments is other investors. And what do other investors demand? They demand a deal. They want to, like, well, if I'm going to invest, I want to see that I'm making some money on this. So they want a deal on investment. So that means you have to sell it at below market cost. And on top of that, there's a smaller pool of individuals you're going to be selling to. An investor will always pay less than the end user, and the end user will pay more because they require a roof over their head. They actually have a fundamental need for that, and they can also develop an emotional connection to the property when they see it, which will drive the property price higher. So if I waited that 1 year, not only am I in a better tax situation, I will be able to sell the property more because I'll have a larger pool of individuals that'll be interested. And then on top of that, in 1 year, the community will, all those little finishing touches will become the community. It'll be somewhere where someone wants to live. So there will be a significant bump from the purchase price from today to when that completes. So three massive reasons why you shouldn't sell. And then actually number four, because if you're in Toronto, maybe you make an argument going like, hey, Alex, I want to avoid the closing costs of land transfer tax, development charges, all those extra costs, HST rebate, which is a considerable cash amount. Again, it's still a terrible idea to sell an assignment, but I'm not going to get in that today. But there are no closing costs in Calgary. So like there is literally no reason for you to sell an assignment in Calgary other than dire financial constraints, and you just really needed to get out of the deal. But even those cases, there's always a way to find a way to close on the deal. Now I said these things. Kyle recently ran the math for someone. Kyle, I'm gonna promote you to co-host, so you can actually. Do you want to show them the math on the screen?
Absolutely.
Yeah. Let's actually show the savings of like how much more money you're going to make by just holding the property for 1 more year, finding a way. So yeah, you got the host duties, host capabilities now, and here's the money you would be leaving on the table.
Perfect. Just getting it set up. Can you guys see that okay?
Mm-hmm.
Awesome, awesome. So these are the three different scenarios, that Alex mentioned: selling it on assignment, closing on the property and immediately selling it, or closing on the property, renting it out for a year and holding it for a year. This is roughly, what the numbers would look like in an imaginary scenario here to give you kind of an idea of the difference of what you can expect. Now, the selling price is not all equal here. In this scenario, I said it was going to be about a 5% difference when you sell it on assignment, because those investors need a profit. They need to see that path to profit. Otherwise, why would they step in? They're not going to pay market value. In actual fact, what I've seen, and I just had an assignment for the situation, a unit that was in the same complex had just closed and they sold it. It sold for $540,000. The best offer on assignment that we got was $490,000, 10% less than the actual market value. Not hypothetical. This is what the previous unit sold for in the resale market. So it would be even a bigger difference than what I'm showing you on this screen. Expect at least a 10% discount to what the market value is that you're immediately leaving on the table by selling on assignment. So just using these numbers though, selling price, if you sell it on assignment, 500,000. If you close on it and immediately sell it, 525, probably more like 550 in actual situation. If you close on the property and rent it out for a year, it's probably going to be not even 550, probably 600,000, because the property will continue to go up in value. So we get more and more conservative in the scenarios as we go along too. So keep that in mind when we take a look at the net profit, at the bottom. So overall, the gross profit then, if you're selling it on assignment, say you bought it for 400,000, selling it for 500, it's going to be about $100,000. From that though, you have significant costs. The developer fees, even if it says free assignment, there's often some sort of fee or legal cost by the developer. I've seen this be $10,000. I've seen this a percent of the purchase price. So definitely check your contracts, because it can be a significant amount of money that you need to pay for the privilege of selling your unit on assignment. There's also legal fees. Typically, assignments are more complicated, so there's additional legal costs above and beyond selling a resale property. And then real estate commissions. Typically, you need to engage a real estate professional like one of us to sell your unit on assignment. And that's typically more expensive because it's much harder to market and get the word out on assignments, because you cannot post them on realtor.ca or MLS. You often can't even post them publicly. Developers do not allow it often in the contracts. So you have to do like back channel marketing and WhatsApp groups, different ways to be able to actually communicate it. And that's another big reason of why you don't get the fair market value either. You can't reach the public like you can when you're selling it on the resale market. So in this scenario, you'd pay about $28,000 in fees. So your profit after those fees would be about $72,000 by selling it on assignment. Now, like Alex mentioned, you have to pay GST on that because it's considered to be business income. That'd be about $3,600. And then you're going to pay income tax on that entire profit as well. And since, say, you're making $100,000, that's going to be added directly on top of the income that you've already earned for the year, taxed at the highest rate, probably bumping you up into 45 to 55% tax bracket. So all your taxes, you're paying over $40,000. So from that $100,000 profit, you're left with about $29,000 in profit. So less than 30%.
And that's best case, because we think you're even giving high numbers on that assignment sale.
Yeah, on the price, it's probably even lower. Probably about 25,000 lower. So you're walking away with $5,000 to $10,000 in your pocket. Versus, you're always better off to close the property and immediately list it for sale. There's ways to do this. You can get private money. I've explored this with different clients. It is possible. You will pay a high interest rate, but it's only for the short term, 60, 90 days while you sell the property and close on it. You're always better off to do that. And in this scenario, sorry, Al?
Oh, I was gonna say, and even when you sell an assignment, it does not release you from the obligations of the contract. So if that person you sold the assignment to, if they didn't close, you're back on the hook for closing on the property again. You go ahead, Kyle.
That's a fantastic point that a lot of people don't understand or realize. Then looking at scenario two, you're going to get more for the selling price. 525 in this example, probably more like 550 if we're using the 500,000 as the base case. Your gross profit about 125,000. Your developer fees are zero because you don't have to pay the developer anything to sell it on assignment anymore because it's a resale property. You've closed it. Your legal fees are going to be lower, and your realtor commissions are likely going to be lower as well because the resale commissions in Calgary are a little bit lower than the typical assignment commission cost. So your profit after taxes, you're about $103,000. You can already see you're quite significantly better off than the selling on assignment case. You still have to pay GST on the profit because you're still selling within that 1 year. So it's still considered as business income. And you're still going to pay income tax on the entire amount, a massive amount, $55,000 in this case. But you're still better off. You're getting net profit of about 43,000, which probably even more again if the purchase price is going to be higher, probably more like 60,000. So you're earning probably about double if you just sell it after closing versus selling it on assignment. But now if we look at the best case scenario, close the property, rent it for a year, and then considering selling it, you're going to get a much higher purchase price. In this example, likely 550 to 600,000. Your original cost is still the same, so your gross profit is going to be anywhere from 125,000 upwards of 200,000. Your developer fees, there are none. Your legal fees are lower. Your real estate commission would be a little bit higher because the selling price is higher, but very minimal. So you would get a much higher profit after the fees and taxes. But even if you sold it at the exact same price as immediately closing on it, then you're still going to be significantly better off because of how the taxes are treated on it. You no longer have to pay the 5% GST because it's no longer business income. It's now become a capital gain. And that's the biggest difference, is now only 50% of the profit is taxable. So your tax bill is going to be cut literally in half, tens of thousands of dollars different. So your net profit in kind of the worst case scenario for selling it after renting it out for a year would be about 75,000 in this case, likely much, much higher. And the difference you can see at the bottom, you'd be $46,000 better off than selling on assignment by closing on it and renting it for a year. So I think the choice is clear, and I would definitely hold it and rent it for a year. If you can't do that, lost a job, something like that, close on it, sell it immediately.
Alex, you're on mute.
Because I was coughing. Yes, 100%. We agree, and we will edit that part of the video and make sure that's a standalone video so we can just send that to people when they say, hey, I want to sell an assignment. Because it just makes zero financial sense. It makes negative financial sense. Not even zero financial sense. It makes terrible financial sense. Anyways, so that's us answering our question of the day. If you have any more questions on that, ask in the Q&A. We'll address at the end of the presentation. So now we'll get into why we are investing in Calgary. So let me just share our presentation here. Let me start the presentation. There's the good looking guys right there. So for those who don't know me, I'm Alex Wilson, broker and owner record of Remax Wealth Builders Real Estate. Been selling Toronto for 15 years. We started investing in Calgary in 2019. Number one Remax agent in Canada for individual transactions in 2022. Number 11 worldwide. Been inducted in the Remax Hall of Fame, awarded the Remax Lifetime Achievement Award at 30 time, and Circle of Legends at 40. But none of that is relevant. What we like to share with you is our investment success, and that's for myself. I've turned a $39,300 deposit into a $17 million portfolio, which includes 15 condos, a High Park triplex, and an apartment building in Hamilton. And I highlight that whole portfolio right here. We always start with this because we want to show people the value of, and especially right now, we just started with that assignment talk. Even in that short period, how much better off you're holding that property, to closing, how much even better off if you're holding it for an additional year. Now, when you extrapolate that and look at it, well, what if I hold the property for 30 years? We want to get people in the mindset of you build real wealth by buying and holding property over a long period of time. So my current market value of my portfolio is just over $17 million, but all those properties have mortgages on them. But the beautiful thing is when you look at things over time, and that will even smooth out the ups and downs throughout a market, including today. My portfolio would be worth $42 million in 30 years. Why do I look at 30 years? Just to keep it simple for everyone here, 30 years, all my mortgages will be paid off, because that's the 30-year amortization period of the portfolio. So when I compare it to the $17 million, which had mortgages, in 30 years, there'll be no mortgages. So that means that my portfolio will be worth $42 million, and I would be worth $42 million, because that's the value of my portfolio. And that growth is at a compounded annual rate of 3%, keeping it nice and simple for everyone. So you can really see the tremendous wealth that you can build over time. And the beautiful thing is, who paid down those mortgages? Not me, the tenants that lived in the properties. So if you just stay the course, keep the properties, work yourself through these ups and downs, you will build tremendous wealth for yourself, and then be able to pass it on to future generations. And now we'll talk about Kyle.
Hi, everyone. My name is Kyle DeVigi. I have been investing in real estate for over a decade now, and I'm the landlord and owner of 6 different properties across Canada. The last one that I personally invested in was in Calgary. So practicing what I preach. Previous to being a real estate agent, I managed Lotto 649 and Lotto Max draws on behalf of the national lotteries. You can see the little lottery balls, sitting in the corner. I used to make millionaires, but now I make millionaires in a different way. I help people build generational wealth by investing in real estate. And this year alone, I've helped over 170 people from across Canada to do just that, by investing in pre-construction properties in Calgary. And here's my portfolio, Alex, if you want to switch the slide.
Yeah, switch.
So this is the 6 different properties. I started with one deposit of $38,500 back in 2012, and I've grown that now into a multi-million-dollar portfolio, and now worth about $4.5 million. If I did nothing more, not adding to the portfolio, not doing anything, in 30 years, that'll be worth over $10 million. That's not including cash flow, principal repayment, or any of that other good stuff at a very conservative 3% growth. This is my retirement fund, and this is what I help people do every day now.
Niesh.
Good afternoon, everyone. My name is Niesh. Glad to have you all on board today. A little bit of a history about my journey in the real estate world. I got licensed in the latter part of 2020 in November, and have a bunch of different accolades here, which I'm not going to get into point by point. But what I want to do is ask Alex to go back. There he is.
Yeah.
I began my real estate journey back in 2006 with my initial principal property in Toronto. And since then, we have purchased 2 in total in Toronto, and we have 7 properties in Calgary. That's including myself and my family members. And the last 7 properties that we purchased were in Calgary. And, I want to talk a little bit about my career prior to getting into the real estate world, but it kind of ties everything together. So I worked in a sales and operational role for over 20 years. And when the world stopped in 2020 with the pandemic, unfortunately, the business that I was in, we weren't positioned to pivot to still be operational and profitable. So I kind of saw the writing on the wall. Thankfully, I had started my real estate license prior to this, so I had a good exit strategy, but a lot of my colleagues didn't. And what I mean by that is they had invested many years into our organization with the expectation that the company would take care of them during their retirement years, whether it's through contributions, through group benefits, or through a RSP matching plan. And of course, they would also depend on the Canada Pension Plan to make their financial years at retirement more enjoyable. That all stopped. So this was really eye-opening to me, because I realized that you really can't depend on anyone or any institution to ensure the financial future of yourself and your family. And as a result, the real estate game became much more important to me to focus on. And through my time spent with Alex and Kyle, was able to learn really how real estate could leverage the money that I had in order to scale quickly in some cases, to ensure that myself and my family had a good financial future, even if things went sideways with the profession that I was in. Very, very important set of numbers I'm going to throw your way. So Canada's population, and sorry, by the way, this is my my portfolio here. Again, we're very transparent. You'll notice that the first two are in Toronto in 2006 and in 2017, and the remaining ones have been in Calgary. I'm actually very excited because my second townhome, we're actually taking possession of that at the end of December or mid-December. So that would be the second townhouse that we're closing on. So pretty excited for that. Jumping back to the numbers that I wanted to share. Canada has a population of 41 million people. And today, more than any other time in our country's past, the age of people in their retirement years has surpassed the prime earning age of people in this country. So essentially the retirement category, it makes up 27% of Canada's population, which is just over 11 million. Whereas, those that are in the ages of 35 to 55, I believe that number is closer to 9 million, 9.8 million, so still lower than the retirement age people. What that might mean is the contributions that we're making to the Canada Pension Plan, we don't really know if that's going to be around when we're ready to retire. So once again, reinforcing the fact that you have to take retirement into your own hands. And over the next, 10, 20, 30 years, if we simply apply a very conservative 3% year-over-year growth in the existing properties that I have, in 30 years, that will be worth $12.5 million. And again, that's at a 3% year-over-year appreciation, very conservative. And it doesn't include any of the cash flow principal repayments that my tenants will be making as I pay down the mortgage. So there's my portfolio, and we can slide on to the next slide.
So we are experts in this. In 2022 alone, we've helped over 350 people from across Canada invest in Calgary and sold over 150 pre-con units. And our team is, that number is actually 15 if we include Nick and Ramin in there as well, 15 Calgary pre-construction units. So not only do we promote investment in Calgary, we are investing in Calgary. We've closed on properties, we've sold properties. We've leased properties, we've managed properties, we've been through every scenario dealing with pre-construction properties in Calgary. So we put our money where our mouth is, and we're continuing to invest there. Kyle just bought another one, or he's in the process of buying another one right now. So we haven't stopped. Specifically the condo market in Calgary is one of the few condo markets in Canada that is still continuing to perform. And then the overall real estate market in Calgary is continuing still to go up. And why is that? Well, it's still affordable. And we're going to go into those details about why we're buying Calgary now. Now, our numbers that we give you, you may be like, oh, well, how am I going to build a $17 million portfolio or $5 million portfolio? We'll just take small little bites to start. So if you look at a portfolio value that's at $1 million, which is about 3 Calgary condos or 2 townhomes or a detached and a half property, that's all you need, and that'll give you $1 million portfolio specifically in Calgary. And when you look at that, if that value is going to be 4.4 million in 30 years, if we adjust for inflation, and then if you want that property to be paid off in 30 years, and then with today's purchasing power, you'd be able to pay yourself $70,000 a year from owning that property. So you just built yourself a pension plan. Now that recommended yearly payout number, that's if I only paid myself a 3% return from the portfolio. And then now we're getting a generational component. So you could pay yourself a return from the portfolio, but still not eat into the value of the property. And it's inflation and protected for the next generation. 2 million, you can pay yourself 140, or 3 million, 210. So you start to see how things snowball. And then how you grow that is you buy a property, it goes up in value. Instead of selling it, you refinance that property, and then you use the down payment, the refinance funds to buy the next property. And then it continues to grow and grow and grow. And that's what we've all done over the last 10 years to grow our portfolios to where they are today. It's just applying the concept of finite resource, which is real estate. There's only so much land for people to build on, and a finite timeline, because we're all going to die. So those are two finite resources combined can build tremendous wealth. So so that's our investing mindset, how we look at investments. So why are we focused on Calgary right now? Well, when we started investing in Calgary in 2019, we didn't know much. So when we started looking at it, we didn't know these things. We didn't know it was the most livable city in North America. We didn't know it was the fourth most livable city in the world. We didn't know that it was, well, we knew it was located in the foothills of the Canadian Rockies, so we knew that. But that was about the extent of what we knew about Calgary, is that there was great skiing only an hour away, and the Rockies being a world-renowned place that people come to visit. But the most massive thing is that it's the second lowest cost of living of Canadian cities and ninth lowest in North America. And that's where we're seeing drive people to that area, is the affordability. And then we're going to get into the diversification of the job market there, and how their economies, not only their economy, but their population growth is outpacing everyone in Canada. So there's the population growth. So we've been seeing net population growth over the last 3 years. And for us, if I'm investing in real estate, I want to see positive population growth, because we're in the business of investing in roofs over heads. On top of that, people in Calgary have money. Calgary is the highest millionaires per capita of major Canadian cities. Calgary represented the highest wage and salaries per employee in the country at 66,000. And something we haven't been talking about a lot, it's on the slide, and I'm going to get the stats for it. But believe it or not, in 2004, Calgary was actually worth more than Toronto. So if you see where the values of Toronto went this way, and then Calgary went this and then went down, and that was because the price of oil fell out. So what you're doing is you're investing in the city, not at the bottom anymore. We've already passed the bottom, and now they're in their upward trajectory. But if you look at the gap in values between Toronto, Vancouver, and Calgary, it is a Grand Canyon of gaps in regards to pricing when we compare these cities. So that's where yes, there's been growth. We've already passed the bottom, but there's a long runway of growth, because it is still an affordable market, and we're seeing these people move there. And when you look at the population growth projections over the next 20 years, that's when you start getting excited. So the Alberta population is set to increase by 48%, will be larger than British Columbia by 2043. That's double the rate of the Ontario population growth by 24%. On top of that, the population of Calgary, which is the population capital and also the economic capital of Calgary, it's going to outsize that growth. It's going to grow by 62.5%. It's going to add 1 million people over the next 20 years. So where do I want to be investing my money? I want to be investing money in a market that is an upswing trajectory, which it is. And on top of that, it's going to be growing the fastest in Canada. And also from an economic perspective, it's going to have the largest economic growth in Canada. So when I combine those three things, even in this interest rate environment, you're going to see big things, especially when you look at things over the longer run. So we do know interest rates will go down at one point. So can you imagine that pricing is going up in Calgary right now, even at today's interest rates? Can you imagine what's going to happen when interest rates starts going down? The growth there is going to be supercharged. And where's that population coming from? Not only is it coming from international migration, it's also coming from the interprovincial migration. So people are leaving places like Toronto, places like British Columbia, other areas in Ontario, and going to that affordable market. Kyle, what percentage of your calls now, because in 2019 it was just investors, but now what percentage of calls are people actually bringing up they may move to Alberta?
Probably 20%, about 1 in 5. And just about everyone nowadays seems to know someone that's moved to Calgary or is considering in the process of doing it too.
Yeah, like that's where you just reading the math, reading the numbers, and the numbers that we're giving you right here, these are Statistics Canada numbers. These aren't our numbers that, hey, we made up. No, this is the federal government of Canada that's providing these numbers, and we're extrapolating that information from. Also, strong economy. When you look at the cities across Canada, Toronto, Montreal, Vancouver, Calgary, the fourth largest economy in Canada. It is larger than entire provinces. It's larger than the economy of Saskatchewan. It's larger than the economy of Manitoba. It's a powerhouse on its own. And Alberta is going to lead Canada by economic growth in coming years. So not only are you going to lead in population growth, you're leading in that the economic growth of the city as the province as well. And Alberta is adding jobs. So all these people that are coming there, well, they all have jobs too. So per capita, Alberta is adding the most jobs per person. Ontario did add more, but Ontario has a much larger population. When you look at the per capita numbers, there are not enough people in Calgary to support all the vacant jobs that are open in Alberta right now. They need more people. And you're going to continue to see that growth in the population. As the ad says, Alberta is calling, and there's money to be made there. And the province is making a significant amount of money. So if you talk typically about budgets and provinces, if you live in Ontario, you're used to hearing the word deficit, deficit, deficit. So we're continuing as a province to add on to our debt levels. Federal government, they use words deficit, deficit, deficit. Federal government is continuing to add on to debt levels. Alberta is surplus. So they had a $13 billion surplus last year. And what do? They used that money to pay down their debt. That's what you do when you have a surplus. And guess what? They already had the lowest debt per capita in Canada, and now it's even lower because they're paying that down. And they're forecast to continue to have surpluses in 2023, 2024, and 2025. And that's based at $70 a barrel of oil, which is it over $90 right now? In the mid 80s right now. But we've been in just most recently in the mid 80s to $90 a barrel of oil. And looking at potentially hitting $100 a barrel of oil again. So that's where you're looking at continued financial fortunes in Alberta. Now, the key thing is when I bring up oil and gas, that's a backbone of the economy, but it's not the growth driver in Alberta anymore. So of all these new jobs we're talking about, they're not in the oil and gas sector. There are no new oil sands developments. Zero, none, nada. There is no new oil sands developments being planned for. No one is investing in establishing new projects. So what happened and why you had a decrease in pricing is that oil prices crashed in 2014. And then that led to massive layoffs. Now, none of those people have been hired back in this latest boom times because guess what? They're not investing in new oil sands projects. So even if oil prices go down, it's going to have no impact on the growth prospects of Alberta. And to that point, when we started investing in Alberta, guess what? There was no COVID. Oil was $60 a barrel. We weren't going, hey, oil is going to be $100 a barrel. You can go watch our videos; they're online. We didn't say any of that. We were focused on the diversification of the economy. Now, there is one positive thing. There is the Trans Mountain Pipeline that's going to help diversify our client base in regards to who we sell oil to. Sorry. That's a positive. But you're looking at strong financial fortunes moving forward in the future with this backbone of the oil and gas, which will then feed into allow them to continue to diversify the economy in Calgary. So diversification away from oil and gas. And this is where I hand it over to Kyle to talk about all the diversification that's happening in Calgary, where we see the growth.
Yeah, thanks, Alex. So yeah, oil and gas, historically, Calgary been live or die on, but we are very fast moving away from that to the point where, yeah, if there was another crash in oil prices, I don't think you'd see the impact of the economy like you did historically, because you have other industries coming in and taking the place. And these are the sorts of industries that you want to see moving in, things like IT. Now, Alex, if you move to the next slide.
Yep.
And it's because, Calgary has one of the highest proportion of STEM graduates, very highly educated workforce. So you're starting to see kind of an incubator community in Calgary, tons of startups coming, and some of those are growing really fast. One of the main reasons is, very low cost of office space. Downtown Calgary is about 1750 a square foot. Toronto is about double that. Vancouver is about triple that. So if you're looking to start up an operation, office space is a very important factor. Highly educated workforce is another critical aspect. Calgary has this in spades right now, and it is starting to really attract those tech companies and other industries. And it's starting to show. You're getting these companies turning into unicorns, companies with billion-dollar valuations. And it's not just one, you've got several of these now, and you should expect more of these in the future too, because as some of these founders, earn significant amounts of money, they like to reinvest in other projects. Take a look at Elon Musk. He didn't start at Tesla. He had PayPal before that, and many other projects. So you're going to continue to see these founders investing in their friends' companies, starting new businesses, and it starts to snowball. And you're really starting to see that in Calgary. But not just tech. Well, I guess tech as well, but bigger companies too. These are household names: Amazon, TELUS, WestJet, all investing significant amounts of money into the economy of Calgary. Amazon's tripling down, but the most exciting one is the Amazon Web Services that they're building in Northeast Calgary, only the second one in Canada. TELUS went all in on Calgary, built a 60-story headquarters, TELUS Sky, in downtown Calgary. They're investing billions into the infrastructure in Alberta and hiring thousands of people there. WestJet made Calgary their international hub for all of their flights. There's only 4 international airports in Canada, and Calgary now has one of those. And they're investing significant amounts of money into the airport there as well. And speaking of planes, we have the Havilland Aircraft Manufacturing Company that is relocating their entire operation from Downsview Park in Toronto. That land's been sold. They have to move, get out of there. And they chose just east of Calgary to relocate their entire operation. It's going to be a 1,500-acre development, a massive new site there. And they're going to be relocating 1,500 jobs. So the east side of Calgary should benefit significantly from de Havilland. And they make water bombers and work planes. I don't know about you, but it was a heck of a summer with all the fires and everything. Their products are absolutely in demand right now. And then back to tech, you have other companies that you might not have ever heard of, but these are big international companies, many based in India: Infosys, Emphasis, SideTrade. These are all companies that are starting operations in Calgary, or what gets me excited, doubling down and expanding their workforces there. Then you have the big guys as well, the banks, financial institutions. You're seeing growth in the financial services area as well. TD setting up a wealth innovation center in Calgary. RBC opening an innovation hub. Same with IBM. These are some of the biggest companies in Canada.
So, why can we say this with confidence? Obviously, we showed you the economic numbers of Alberta. We showed you the population growth numbers on Alberta. But on top of that, we've already seen this happen before in the United States. So we've been seeing companies leave California and states like New York and go to lower cost environments. So why are they leaving California, for example? Well, they're fleeing high taxes. They're moving to places like Texas. Well, when we compare that to Canada, Alberta has the lowest corporate tax rate in Canada. On top of that, they have no provincial sales tax. So there is no, we have HST in Ontario, which is 13%. They only have the federal component, which is the GST, which is 5%. There's no provincial component. There's no land transfer tax when we sell. So when we talk about, when we're talking about the, why it makes no sense to sell an assignment there are no closing costs. If I'm buying in Ontario, I do have significant closing costs. There are no extra costs there. Expensive housing. So it's very expensive. We don't use the word affordable when we talk about Toronto or Vancouver, but we do when we talk about Calgary. It's the second most affordable city in Canada and the ninth most affordable city in North America. That's what, when companies are leaving San Francisco and going to Texas, that's what they're citing when they move into markets like Austin, Texas. Also government regulations. California is one of the tightest jurisdictions for red tape in America. Texas is very free, very free. Alberta is the business friendly environment. It has the limited red tape there. So you see these companies that are going to be leaving these higher cost jurisdictions, higher tax jurisdictions, more difficult to do business jurisdictions, and they're going to go to the easier ones. And that's what Alberta has to offer. And we've seen it already happen in the US, especially when we get into this higher cost interest environment. Companies are going to be looking where they can save money. You can save money in taxes, and I can save money in office space by operating in Alberta. Whoops. Back to my slideshow. Okay. So the policies are pro-business. There's no rent control, no foreign buyer tax, no land transfer tax, no provincial sales tax, no development charges. So you're just talking about the landlord-friendly environment out there. There's no rent control. There's fixed term leases. So at the end of a lease, at the end of 1 year, you can tell a tenant to leave. So when Kyle gave his example, hey, keep your property for a year. You can rent it out at the end of that 1 year. You can tell your tenant to leave. You can't do that in Ontario. Once you put a tenant in there, the only way to get a tenant out is if you own or occupy the unit, or if the seller, the person buying it, is then going to occupy it. But you have to sell it with the tenant in place. There you do not, which allows you to get a better return on your property when you go to sell it. You don't need to sell it with the tenant in it. In Ontario, you do. You don't have any control over that. On top of that, is if a tenant stops paying you rent, it'll take you 8 to 12 months to get them out of the property in Ontario. That's no money for 8 to 12 months versus in Alberta, which also can impact the sale of a property as well, because you can't get the tenant out. In Alberta, it takes 2 to 3 weeks to get the tenant out. Again, very favorable environment. Now, Niesh, you want to go over quickly, just talk about our current offerings, and then I want to jump into the Q&A portion because the questions are piling up and it's already 12:46.
Yeah, great point. I was going to mention that, and some of the questions we've already answered, and I think we'll answer a few more as we go to the next few slides. So really excited to talk about what we have currently and what we have coming up. So as you know, Calgary, it's split into 4 different quadrants, and we have options pretty much through all areas of the city. And the options include everything from low-rise condos all the way to single-family homes. What's phenomenal about the developers that we work with, they provide a very easy down payment structure. And we also have closings that are that range from next year all the way until 2028. One of the biggest reasons why I was able to scale my own portfolio, because I had such low initial capital costs for the down payments, and also staggered closings, which allows you to buy properties quicker. We have properties in the Northeast. Our newest property is called Mine Condos. They start in the low to mid $300,000 range. They come with a 2-year rental guarantee, which means the developer offers an incentive where they will lease the unit from you and they will manage the tenant. They'll find the tenant. They will pretty much handle them, no cost to you. One of the questions that came up was, hey, what if I don't want to keep the existing tenant when I take over? Well, you don't have to. As Alex mentioned, there's fixed term leases. So as you come up to the end of that rental guarantee, if you provide proper notice, you can have them out and get a new tenant in there, whether you're looking to rent it out again or have or sell the property. So we have condos. We also have the higher end version of the condos in the downtown core, in the Beltline, which is probably one of the most desirable areas in the heart of the city. They start in the high $400,000 range. Also has a 2-year rental guarantee and a phenomenal incentive package. They close in 2028. And we have townhomes. Now, townhomes is a really good medium between a condo and a single family home, because you have the room and the space of a single family home, but you have some of the benefits of the condo component, where many of the things that you need to take care of in a single family home is taken care of through the condo corporation and your contributions to the condo maintenance fees that you'll be paying. And those we have closing in 2026. And then finally, we have your standard single family homes and duplexes, which start in the low to mid $600,000 range, and they go all the way up to 700 if you are looking at a property with a second unit, a legal unit for additional income coming in. And these options offer a 15% down payment, which is spread over the course of anywhere between 4 months to a year, depending on the project. And, looking at some of these prices, I'm sure for those that live in more expensive markets, this is, more than a decade ago that we could offer prices like this in bigger cities.
I'm going to stop the share now, and we'll just jump into the Q&A because we respect everyone's time. And also, all our this is all recorded, so there'll be a summary email that goes out after with this recording, and then all our projects and an opportunity to for us to answer any additional questions, or you can book a call and we can go over all those different product options, which may make the most sense to you. So just question here. When you're in a rental guarantee, because a lot of the projects we offer have a rental guarantee, do you have input on the tenant? Do you get to choose the tenant? No, you do not. What it is, it's a lease back. So what that means is the builder is leasing back the unit from you at a set rent. So they're taking the risk on of the unit sitting vacant or not. And in the contract, you're going to get that set amount of rent that's stipulated in the contract. And that's going to include full property management as well. But you do not have input on the tenant. Treat this, the rental guarantee as an insurance policy, but most likely you're going to opt out of that rental guarantee. Niesh has opted out of his rental guarantees for his units, and he's renting them for much more because the market is commanding much more. So if you want to control who you put into your property, then I would say you'd want to opt out of the rental guarantee program. Now someone's asking about, I'm losing money on a monthly basis on my properties from a cash flow perspective. Looking at the numbers they're using, they're probably Toronto properties. What's my line for that? Is the line is survive till 2025. So real estate investors, you want to survive till 2025. So yeah, you're going to be taking a monthly cash flow hit right now, but you'll be in a better off situation in 2025. And that negative cash flow, that is also that's written off against your income from your taxes as well. So that does become a tax write-off. And when you look at that negative cash flow, you got to factor in part of that is principal payback too. So this example someone's using is saying they're losing $1,000 a month on their property. Well, part of that is still paying down your principal. So you got to take that principal component on. That's your actual negative component. So you just have to weigh the pro and cons. So let's say it works out to $750 a month after you principal pay down. So $750 a month. 10 months at 750,000 plus another 7,500 plus another 15. So over a year, that's $9,000. But if I wait another year and I sell it for $20,000 more than my net outcome, I'm still better off by $11,000. So you got to think of things that way. So that's why you got to survive to 2025. So you want to wait till those interest rates start coming down. We have, for the most part, peaked. Maybe we'll still have another increase, but for the most part, we've peaked. We'll probably stay at this rate for 2024, maybe all of 2024, but not going down until third or fourth quarter 2024, and then you'll see rates continue to drop into 2025, and then you'll be able to sell the property for more, and your cash flow will be in a better situation. So, I'm in the boat. Don't worry, I'm in the boat.
Alex, one quick thing to add about the cash flow stuff in Calgary. When you look at some of the prices, even with today's interest rates, with the way their rental market is, you're going to be cash flowing. Like I'm cash flowing, and my interest rate on one of my properties is 7%. But simply because the cost to enter that market is so much lower than other markets, and the rental numbers there are phenomenal. I have a surplus, just like the province of Alberta. I'm making money every month.
Yeah, exactly. Yeah. So again, that's where the $1,000 a month, that's got to be a Toronto property, not a Calgary property. So I guess the answer is also invest in Calgary. Also, you can also put more money down, right? Like, so our examples are traditional 80% down, but guess what? You can make any property cash flow. It just means you put more money down. It's going to impact the return of your investment. But if you have the ability to put money down, you can eliminate negative cash flow, but just by putting more money down. So someone asking here, I will answer this. Would it make more sense to borrow against current investment properties to purchase in this rate versus rent environment if you're only putting 20% down? Well, it doesn't matter, because that means you're generating excess cash flow in other properties, which is going to offset the negative cash flow. So, okay, I don't think I read the question for everyone really clearly. Let's say I have a property that's generating excess cash flow by $1,000. Then the new property I get is generating negative cash flow. Well, they cross each other out, so my net portfolio is zero. So when if you have one that's is negative, but the rest are positive, look at the overall value of your rental portfolio. That's actually your cash flow for your entire portfolio. Why is downtown office vacancy still so high in Calgary? Well, what happened was when you had oil money coming in, and oil was at record levels in the late 2009, 2010, you had huge high oil numbers, and then there was a massive commercial building boom that followed, and then the price fell at oil, and there was mass layoffs. And again, as I said, the people weren't rehired, so that was just excess office space from the oil companies years and years ago. And a lot of that space they're looking at converting to residential. So Calgary is the only city that actually has a plan in place to successfully convert office buildings into residential. You don't have that in any other jurisdictions because they're so far ahead of the curve than all these other jurisdictions, because they hadn't had to look at that before. So that's why office vacancy is so high in Calgary. Are there any projects close to the university? We do have projects that are downtown Calgary that would be transit accessible to the university. Again, book a call with us. We can talk about what those projects are. Do you guys handle property management, Calgary and Toronto? If you do, whom should I contact? We do have a property management company we own in Toronto. Just reply to the email that you got to sign up for this webinar, and then we have partner property management companies that we can send you the details for in Calgary. Do you guys share the PowerPoint presentation on top? But even better, we share the video. So this whole thing is videotaped, which includes the PowerPoint presentation. How can I refinance and get more money to invest in another condo if I am retired? I have tried, but the bank is based on my income. Again, talk to your mortgage professionals and see what the best way is to see if they can leverage more money out of your existing properties. I think we've covered off everything here for the questions, and we are at the hour mark. We don't want to take any more of anyone's time. As I said, this has been all recorded. You will get a copy of this recording. You will get all our opportunities to invest in Calgary. As I said, we are all invested there. We truly believe in it. It's just starting. It's run up. And the proof is in the pudding. Prices are still going up in Calgary in this interest rate environment. It's one of the only jurisdictions in Canada. So just imagine what's going to happen when prices drop, and you're locking into properties that are going to be closing in those lower interest rate environments, which will help the return on your investment. So thank you everyone for coming online. We really appreciate it. I missed one call here. How will the 65% LVR impact our ability to pull out equity? If you refinance, it's still 80%. The 65 is for a line of credit. I missed that question there. Okay, thank you everyone. Really appreciate it. We'll talk to everyone soon. If you have any questions, book a call with us. We'll chat. Okay, bye everyone.